In a move signaling caution amid economic uncertainty, the Federal Reserve lowered its benchmark interest rate by 25 basis points, setting the target range at 3.75% to 4%. The decision, described as risk management oriented, reflects a cautious stance rather than a response to clear economic deterioration. Officials noted that U.S. economic conditions remain broadly stable, with employment markets showing only mild softening and unemployment still low. Notably, the vote was nearly unanimous, with just two dissenters, one favoring a larger 50 basis point cut and the other opposing any reduction. Looking ahead to the December meeting, Fed members appear divided, with many advocating a pause to gather more data. A key obstacle is the current U.S. government shutdown, which limits the availability of timely economic indicators. The Fed emphasized that future policy actions will depend heavily on incoming data, indirectly shifting pressure to fiscal authorities. A more significant development lies in the Fed plan to stop shrinking its balance sheet starting in December. Since the financial crisis of 2008, the central bank expanded its holdings through quantitative easing, then began unwinding them in 2017. Now, the monthly runoff of $40 billion, comprising $5 billion in treasuries and $35 billion in mortgage-backed securities, will cease. Going forward, proceeds from maturing mortgage-backed securities will be reinvested into short-term treasury securities. This shift marks the end of a 17-year policy normalization cycle and signals a strategic pivot. By holding more liquid assets, the Fed positions itself to respond swiftly if global or domestic conditions worsen. The move aims not to stimulate the economy directly, but to safeguard financial stability, support asset prices, and reduce exposure to housing market distortions. It underscores growing concern about future uncertainty and a clear intent to protect U.S. financial markets and Wall Street interests.